All right, everyone, so we're going to keep going here with Chapter 2, Part 3, What Makes a Stock Strong? All right, so in today's lesson, and this is a really important one because ultimately trading strong stocks is one of the biggest pillars of my strategy. Trading a strong stock. If I trade weak stocks, if I trade choppy stocks, I'm almost definitely going to lose money. So what makes a stock strong? And I'm going to summarize it here in these seven sort of specific components. Number one, volatility creates opportunity. Number two, fear in the market. Number three, greed in the market. Number four, supply and demand. Number five, retail versus institutional traders. Number six, high relative volume. And number seven, former runner and herd mentality. So as we get into for those of you guys, which is probably going to be the majority of you who continue on into the Warrior Pro classes, in the small cap day trading course in Chapter 2 and Chapter 3, we're going to be talking a lot about stock selection. We'll talk about risk management in Chapter 2 and then into stock selection in Chapter 3. Stock selection is so important. It's much more important than trading the right patterns because ultimately you have to trade the right stock. The wrong pattern on the right stock is better than the right pattern on the wrong stock. You trade the wrong stock and you're going to trade choppy price action. You're going to have unnecessary losses. You're going to get super frustrated and you're going to lose money. So being able to identify what is a strong stock and being able to genuinely say what is the strongest stock today is very important. Yeah, I see that my lighting is a little darker than it was. I think it's just the it's so bright outside right now that it's for that reason. But that I think that's okay. So why don't we go ahead and jump in here. Number one, we are hunters of volatility. And I've got kind of a fair amount of text on this slide. I'm going to read it for you so you can take some notes. As traders, we're hunters of volatility. Active traders profit from markets that are moving, whether it's commodities, options, penny stocks, cryptos, or regular stocks. It's emotions that create movement in the market. In other words, emotions such as fear and greed drive the markets, all markets. Financial instruments that are the most volatile are the ones experiencing the biggest imbalance between supply and demand, the most extreme imbalance. So we have a radar, so to speak, to search the market for opportunities. So with this radar, boop, 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 we're searching the market. And these take the form of scanners, which we'll discuss in quite a bit of depth later in this course. In order for a stock to pop up on our radar, aka our scanner, they will also be, of course, popping up not just on our scanners, but on the scanners and radars of brokers, financial news networks, all around the world. A stock has to already be moving. Therefore, you will almost never see me trading a stock that's not moving. Now, there may be a time where you'll see me take a trade on a stock that's lighter volume, but it's up 35%. And there's news that it's got, clinical trial results on an FDA or pharmaceutical company, or it's got FDA announcement, or it's got quarterly earnings or annual earnings. It's got some type of catalyst that's driving the move. And even though the volume is light, I would consider that as an opportunity to be perhaps one of the first people to buy a very strong stock, which is always good. You do have to be careful with light volume because it means that not a lot of people are seeing it yet. But what we focus on are stocks that are already starting to move. So, if someone, from time to time, someone will call out a stock or mention a stock that's just totally flatlining. And I'm like, I just say, listen, this does not make sense. This is not something that you want to be trading. Thanks, Edwin, for that comment. I will double check that on my side, but thank you for that comment. So I never buy a stock that's not moving. I only buy stocks that have already started to move up, and that's typically at least 5, 10, 15, 20% or more. And while these are already extended in their gains, buying high and selling higher is the basis of a momentum trading strategy That is what we do. There is no way you could buy Tesla low and sell it higher. Tesla is high. It's been high for over a year. So any trades on Tesla would have been momentum. Buy high, sell higher. And that's true on even just an intraday stock like OBLN. OBLN, pretty much every trade on this would have been buy high, sell higher. And you could have done really well on that until, of course, the very top. And so generally, when I'm trading, I keep trading until I start to lose money. Because if I start to lose, then I've kind of hit my top. So I keep buying high, selling higher, buying high, selling higher until that first loss. So part of our job, and I'm going to have to move my tape that I have on my monitor here so I can read this. So part of our job is to not just hunt for volatility, but to be selective and choose the best opportunities. The best opportunities with the most are the ones that are most volatile, but also have the highest relative volume. Higher relative volume means the stock is actively being watched and traded by many traders all around the world. So let me put my camera back up and we'll talk this out a little bit more. So one of the biggest takeaways of this slide is that I want to trade stocks that are moving. Stocks that are going sideways are not interesting to me. I do not want to trade stocks going sideways. I trade stocks that are moving 5, 10, 15, 20% or more. Generally, for a stock to be moving, there's something driving the move. We'll talk about that in a second. But it's important to be able to understand the context of whether the market is hot or cold, certainly, and also what is the strongest stock today. It's important to be mindful about the strongest stock today because it ultimately will be the stock that gets the most traders' attention, that has the best follow through, and that makes the biggest move. So while today that was probably OBLN, there might have been 4 or 5 other stocks that were decent, but not strong enough. They just didn't have enough interest. They didn't have, they were close, but they weren't enough. So it's important to have that perspective of, is this the strongest stock today? Is this really the best one? Or is there another one out there that might be a little bit stronger? We usually want to trade the best. Number 2, we see fear generally as an opportunity. Fear in the markets can take many forms. We see it as the fear of missing out when traders are seeing others making a lot of money, and sort of that fear that they're missing out can encourage irrational trading. It's even happened to me. If I see someone in the room tell me they made 100 grand today on OBLN, I won't be able to help but feel FOMO and feel, oh my gosh, I regret that I missed that. And now I want to see if maybe I can make a little bit more. I've missed it, and maybe there's a little more in it. On the other hand, a fear of loss can make traders panic and bail out of positions. Maybe they bought too high, and then now they're giving in, and it's flushing back down. So fear really and greed drive the market in a very extreme way. A move on OBLN of 400% in one day is no doubt a FOMO type of move. People having, fear of missing out and just jumping into it aggressively. And this surge right here from about 632 all the way up to the high of 970, that's very impressive. So there's definitely some FOMO that was kicking in on this one, but that FOMO might have also triggered some people to buy it way up at 9 who are now holding and hoping it turns around. So we always have to remember to cut our losses when things are not going the right way. Not out of a position of fear and panic, but out of a position of calm, cool, collected trading and respecting the levels that are in play. Now we also capitalize on greed. Greed in the market starts to kick in when you're seeing lots of stocks making big moves and you're trying to make as much as possible in a limited period of time. So tomorrow, given the fact that OBLN made a phenomenal move today, I could just about guarantee you that there will be traders who missed OBLN today, like me, who will try to make up for it tomorrow. So the first stock that starts to open up, that looks like it's the obvious stock, that is truly strong, that meets all of our criteria for being strong, will probably get better follow through tomorrow than it might on an ordinary day. And that's because the fear and greed in the market that were kind of fueled up a little bit today are going to be pouring over into the next day. That's very common. We see that both on an intraday basis, that when sometimes one stock is strong, we'll see 2, 3, 4 others that start to pick up, but we also see it sort of on a day-to-day basis. And for that reason, what you'll notice about my trading is that typically My biggest winners are all very close together, but my biggest losers are also close together. When the market's hot, I'm kind of jumping on everything that's hot and I'm doing really well. So my two biggest green days of all time were 3 days apart. And my biggest losses of all time, or my biggest red days of all time, are also really close together. It's just when the market's hot, things are going well, and when it's cold and cooling off, things are slowing down. So being able to adapt to that market is certainly important. We wouldn't want to be trading something like this. This is a stock that's just going sideways. Occasionally someone will mention something like this, and it's just, no, there's nothing there. There's nothing there on this for us to trade. We do not trade stocks like this. We trade stocks like this. This is a HMNY stock chart. HMNY is the stock. And this went from $6 up to $8. Now that's a nice move. Of course, the move on OBLN is actually bigger, but these are the types of moves that we like to trade. And this is where emotions are going to start to pick up a little bit. And when the emotions start to pick up, this is where the ability to maintain the discipline of following your strategy is very important, because this is where it could be easy to start to chase things, to start to let FOMO get the best of us, and to get ourselves into trouble. And we've all been there. I have my students, some of my students who are part of the 100K club will talk to me on some of them on a more regular basis and fill me in. And there have been many days where one will, I'll see one say, okay, I'm done trading. And then they, half an hour later, they're like, yeah, I took the one more trade and I'm back to break even on the day. Where it's like they just went for that last trade and they lost their willpower. So that's always a reminder each day to try to trade as aggressively as you can, but take that profit out of the market. So, with that in mind, something that I would encourage you to write down, 10 cents a day. 10 cents a day. That's 10 cents per share per day. If you could consistently pull 10 cents a day out of the market, 10 cents a day. Now with 100 shares, that's only $10. 1,000 shares, that's $100. 5,000 shares, that's $500. 10 cents a day. It's almost silly to think that the difference between success and failure could be as little as 10 cents a day per share. Doesn't sound like a lot, but it's a challenge, and that's your goal. If you can do 10 cents a day per share consistently, that is something that you can scale. And so if we look at something like whatever, this OBLN, it's very easy to just jump in with a haphazard entry right here. I have no idea. I'm not even really looking at the chart, and instantly be down 10 or 15 cents, and now it's going the wrong direction. So being really disciplined about trading the right stocks and about taking really good quality entries is going to be critical to your success. 10 cents a day, it might sound easy, but here right now I'm only up, well, there's 10 cents right there. Selling, if I get my exit at 48, which it doesn't look like I did. I tried with the order and I didn't quite get filled. Now I'm back to break even. But again, that 10 cents a day, that's all I need. And there we go, I got it out. So I only have to do that once a day. So if you set that as your goal, then suddenly it's like, okay, I only need to take one trade a day. I really have to focus on the very, very best. And I have to focus on the right type of stock. So this comes to home runs versus base hits. As a trader with a small account, contrary to what some people might tell you, I think it's much better to focus on base hits. The problem is, if you try to swing for a home run, you might say, well, Ross, I'm only trading with 100 shares, 10 cents a share after commissions and fees. That's actually a losing trade. Okay, well, that may be the case with 100 shares. But if you could prove that you were consistently profitable with 100 shares before commission, and then you scale it up to 3,000 shares, now all of a sudden the profitability is changing. So sometimes there's this economy of scale where what is not profitable with 100 shares is profitable with 1,000 or with 5,000. And so prove profitability before commissions and fees. The simulator, this is all showing you before commissions and fees. So this is an easy way of saying, okay, I made money today. Now, the question is, yeah, you do want to start to back those fees in and make sure, it's realistic. But in my opinion, if you're starting with small size and then scaling up, 10, 15, 20 cents a day is perfectly realistic for a profit target as long as you're trading with large enough share size. So the problem is, and I've done this myself. I did this on, was it yesterday? No, it was Friday. It was on Friday. I took a trade on a stock, and because I had been red on Thursday, I decided to trade with smaller size on Friday. So I took a position on a stock at like $9.80, and it rips up to $10.50 or whatever it was. So I'm up 70 cents a share. I didn't take any of it off the table, even though that was more than just a base hit. That was like an awesome trade. I didn't take any of it off the table. I held the whole thing because I was like, well, with smaller share size, I haven't really made that much money. Ended up coming back to break even. So that was not a very smart move. What I should have done was, regardless of share size, traded it the right way, which is to take profit into the breakout and then be willing to get back in for the next leg up. And so sometimes with small share size, people will say, oh, I'm in with 100 shares. You know, yeah, there's Ross. He made $2,000 on a 10,000 share position, getting 20 cents, but I only have 100 shares. I'm only up 20 bucks. It's not worth it for me to sell. My feeling is that you should treat it just like it is 1,000 shares or like it's 5,000 shares. Because if you get into this mindset of, oh, I'm trading 100 shares, I'm only going to take profit when I'm up $1 a share, now you're trying to capture much bigger moves in the market, which if you could scale that to 10,000 shares, you'd be talking about making, 10, 20,000 a day. And that's setting the bar way too high. So it's all a ratio. If you're trying to make $1 a share with 100 shares, that's the equivalent of trading 10,000 a day with 10,000 shares. Most people who trade with 10,000 shares do not make 10,000 a day. Most people don't make a full $1 a share out of the market per day. For most, it's probably anywhere from 15 to 25 cents, maybe 50 cents. Maybe on an amazing day you get $1 or more, but that is not going to be your everyday routine. It just won't be. So my opinion is focus on base hits. Take those base hits. Yes, with small size, they don't even cover commissions. But once you start to gain confidence, then you increase your share size, and then you're taking those same trades with 1,000, 2,000 shares. You're popping in, you're popping back out. It's 150 bucks. Do that twice a day, you're talking about $300. That's making some progress. That's my opinion on it. And that's what I've done whenever I've done small account challenges. Number 4, we need an imbalance between supply and demand. So a home run stock, or the right type of stock to trade, not that we're swinging for a home run, but that we want stocks to have the potential to make big moves, would be stocks that are moving 20 or 30% or more. That's at a minimum 20 to 30%. Something like OBLN going up 300, 400% is, we love that, but we don't see that every day. So what creates a big move like that? Ultimately, it's an incredible amount of demand for the stock, lots and lots of people buying it, with a very limited amount of supply. Not a lot of shares available. An imbalance between supply and demand. So let's get into the supply side of the equation. When a company does an initial public offering, they're selling shares onto the open market. So the example that I make, spent some time talking with Uncle Steve, and he's not so happy about his hairline. Well, fortunately, I don't have that problem, but I could understand how frustrating that is. So we've decided that Warrior Trading is going to go into the hair business. So we're going to try to help Uncle Steve regrow his hair, but we need to raise some money to do it. So we're going to do an initial public offering. We're going to sell 10 million shares onto the open market. We have an underwriter who says they think they can get us $10 a share. And so for that 10 million shares, we're going to raise $100 million to invest into Uncle Steve's hair rejuvenation program. Uncle Steve's famous hair shampoo. That's going to be our new product. And maybe I'll try it out. I don't need it, but maybe I'll try it out. Now, from that point forward, we've sold 10 million shares onto the open market. We took the $100 million and we reinvested it into the company. The shareholders wanted us to do this. They believed in our product, and so this is what we did. It was a good move. Okay, so we have 10 million shares that are available to trade. That is the float. The number of shares available to trade is the float. From this point forward, 100 million shares is a fixed number of shares. So every time you're buying shares, ultimately, you're buying from someone who's selling. And that might be confusing at first, but if I buy right here at 768, I'm buying from someone who's selling shares at 768 or now 769. And the person selling is happy that someone bought their shares. So there's always someone on the other side of the trade. Maybe it's a high frequency trading algorithm. Maybe it's a market maker, one of the big banks. Maybe it's a hedge fund. Maybe it's an institutional trader. Maybe it's another day trader. We don't really know. But there's always a match to the order because we're all trading with a limited number of shares each day. So at the end of the day, there's someone out there holding every single one of those shares at some price. Now, what we don't know is of the 10 million shares that were sold on the market, there may be 7 million of them that one big investor bought, has tucked away, and no one's trading those shares. Those are his. He's holding them. So the float is a certain number of shares, but then the actual number of shares that are really free and that are changing hands could be much, much smaller. And that smaller number of shares is ultimately what's trading hands every single day. So a stock like OBLN has a float of 6 million shares and has traded 321 million shares today. 321 million shares in one day. Think about how many times that small little handful of shares has rolled over again and again and again and again. All right. So initial public offerings, although we do sometimes trade the IPO day, what's more important about the IPO in this instance is that that's the moment when a number of shares becomes released. As we go a little further into the classes, we're going to talk about reverse splits, and we're going to talk about secondary offerings. But let's leave that for a moment. So the float right now is the number of shares available to trade. Now that's the supply side. On the demand side, what creates demand for a stock? You tell me. Why is a stock trading? Yesterday, OBLN, or 2 days ago, it traded with 153,000 shares of volume, 153,000. And today, it's got 300 million. How in the world? News. We've got news. Here we go. This is what it is. There's a news headline. There's a news headline here. There's another news headline here speaking about the headline. So this is our headline. We've got news on the stock, and that news has created an incredible amount of interest in the stock. This is also the biggest gainer in the entire US market today. That means it's on the top of a lot of websites, a lot of financial websites, a lot of financial news networks, TV and internet news. It's going to be a stock that a lot of people are talking about, a lot of people are thinking about. All right. So this is important. This is creating demand. And at a certain point, the fact that the stock is up 200 or 300% by itself is creating demand because people are like, I'm buying the stock because it's up. Why is it up? It's up because other people are buying it. I don't know. At this point, I don't even know. So that's what we're all trading, a news catalyst. And again, because the stock is the leading mover in the entire market, by itself, that becomes a form of a catalyst. So finding strong setups ultimately is the next step. We understand the right type of stock to trade, and we understand that we need to have that imbalance between supply and demand, but that's certainly not enough. As we get more into the advanced classes, we'll be talking about the setups in a lot of detail. Right now, we're just talking about what makes a stock strong. Number 5, let's talk about retail traders versus institutional traders. So an institutional trader is a trader licensed by the SEC, right? They work for banks, hedge funds, pension funds. They have an obligation to the people whose money they're trading. Institutional traders will take positions based on orders from their fund managers. Their mission is to accumulate positions at the best price possible. They, through that, invariably create buying support. When stocks start to drop, they're given instructions to start to buy up those pullbacks to get a good price. And these types of institutional traders also use high frequency trading algorithms and create that algorithmic trading volume where as soon as a news headline breaks, you'll see a stock will spike up instantly. How does that happen? How is it that by the time you've pulled up the stock, it's already halted going up 15, 20%, whatever it is? It's because of the algorithms that buy as soon as those headlines hit the wire. All right, so what comes first, the news or the move? It's the news, and then the computer interprets the news and buys the stock. And if the computer is right, retail traders will then come in. Retail traders are traders like you and me. We don't have a license where we just trade our own money, essentially. We then come in, And manually, institutional traders come in with their own just sort of manual trades and start trading. Now, sometimes algorithmic trades are wrong. They'll interpret the news, it'll go up, and then it immediately reverses as traders who are smarter than the computer understand what's going on. But oftentimes they are right, with news headlines being straightforward enough. And what starts to go up and stops for a moment on a volatility pause, which we'll talk about again in a moment, then continues as more retail traders jump in. So our job usually is to look for what has already started to move. And that move may have begun through institutional trading and then is kind of picked up by retail traders and other institutional traders. Number 6, and I'll hide my video again here. Now we're going to talk about the importance of high relative volume. And OBLN is a perfect example of that. Yesterday it had 150,000 shares of volume. Today it's got 300 million shares of volume. The ratio of relative volume on this is astronomical. It is insane. Relative volume it's a numerical measurement of what is the average volume of this stock. The average volume of this stock over the last 30 days, let's say it's 150,000 shares. If the stock trades 150,000 shares, its relative volume is 1. If it trades 75,000 shares, its relative volume is 0.5. If it trades 300,000 shares, its relative volume is 2. If it trades 3 million shares, its relative volume is 20, right? If it trades 300 million shares, its relative volume is whatever that is, crazy high number. So a stock has, and I'll just read this slide for you again, a stock has a number, which is the stock's average daily volume, or the average shares traded over the course of 30 days. Again, if a stock has an average relative volume of 250,000 shares and then trades 2.5 million shares in one day, it'll have a relative volume of 10.00 on that day. The higher the relative volume, the better. Why? Because it indicates a sudden interest in the stock, which is typically the result of a fundamental catalyst, which we'll be discussing in Chapter 4. Likely, the stock has put out news, and initially some algorithmic trading systems saw the news and executed buy orders. Next thing we know, retail traders and perhaps some more institutional traders are jumping in, and the stock is now at 15, 20, 30%, maybe 50%, maybe 100%. At this point, the stock becomes one of the top 5 leading percentage gainers on Wall Street and is hitting the top stock lists at brokers, news networks, and on trading platforms all around the world. Trading platforms that are trading the U.S. market. With the stock right in front of everyone to see, traders begin to look for opportunities and trade the stock as it continues to move up. And now the fact that it's up up 30, 50% itself becomes a form of a catalyst as people jump in, not wanting to miss the action. The end result is a stock with tremendously higher volume today than average, and traders all around the world watching the stock and the trading patterns are now being well respected just due to the number of people seeing them. It becomes a bit of a self-fulfilling prophecy. The hunt each day is for this type of stock, and while we will find it on most days, we won't find it every single day. And on days that we really can't find it, well, then it may make more sense to trade less or to not trade at all, rather than to lower our quality standard so we're willing to trade poor quality setups. So that's a bit of a mouthful, but written there because it's important. And so I hope you take some notes on that. Now, this is my performance based on relative volume. So I aggregate my data and I have these reports generated for me so I can see and understand and analyze my trading performance. 99% of my profits right here are on stocks that have 500 times or higher relative volume, which would mean the relative volume is 5.00 or higher. 1, of course, is standard, and so 5 times is 500%. So 5 times higher, 500% higher than normal. That means I'm trading 99% of the stock, 99% of the time stocks that have some type of news catalyst, but are almost definitely the leading relative volume stock in the market and probably one of the leading percentage gainers. Now, my performance by the instrument's prior relative volume tells a little bit more of the story. While the majority is on this day here, which is 5 times higher than the previous day, quite a bit is actually when it's a little lower than the previous day. So let's look at an example of a chart here on WNW. WNW is a stock that on day 1 was very high relative volume because it was an IPO. Day 2, it was extremely high relative volume and higher than the previous day. Day 3, when it went to 160, was actually lower relative volume than the previous day. It was slightly lower, even though it went higher. And so, so this was a continuation setup. So this was day 1, lighter volume, but high relative. Day 2, very, very high. Day 3, slightly lighter volume. OBLN tomorrow, I may trade OBLN tomorrow, and there's a pretty good chance that the volume could be lighter tomorrow than today, but still very high above its 30-day average. Okay, so that's what this story tells, is the story of me trading stocks that are continuing to move that began on the prior day. And number 7 is former runner status and herd mentality. So a stock, currency, or commodity, Bitcoin is no exception, that has a history of making really big moves is always worth keeping on close watch. There's a certain amount of herd mentality in the market, meaning traders often congregate around certain financial instruments, especially when they're known to provide great trade opportunities. Tesla this year, Amazon, Zoom, Netflix, those are large cap stocks that certainly are true of this, but it's also true of stocks like intraday, on this particular day, OBLN being the most popular stock today. And so all traders are probably congregating on the stock, which is why the volume is so high. I generally find that it's better to trade with the pack. Technical patterns that we'll discuss in Chapter 5 will respond better when the trading volume is above average. More people looking at the stock, more people recognizing the pattern. This is all a good thing when it comes to whether or not we should expect the pattern to resolve positively. It's just sort of the way it's always been in my experience. So asking yourself when you're trading, is this stock obvious today? Is this the one? Is important. And sometimes I do find myself trading stocks that really aren't the one, but that are moving up enough that I say, all right, I'll give it a shot. I'll take a trade on it. And usually, not always, but usually that's a mistake. Usually it's a mistake. I should usually just focus on what is really, really strong, not just the strongest today, but it's not only the strongest today, but also just generally as strong. Sometimes in a cold market, we'll see something that's the strongest today, but compared to a better day, it's really not that strong. And those are days that if we overtrade, we could dig ourselves a pretty big hole, and it's probably not worth it and not a good idea. So is the stock obvious today? So this is just me basically writing out what I just said. Is it the obvious stock that every day trader will be actively watching? For it to be obvious, it should be one of the leading gappers and gainers in the entire market. This means the stock is at the top list of all the brokers, websites, financial news networks around the world. More eyes on it means higher relative volume, more interest. Sometimes the obvious stock won't be the one that fits within my strategy due to price or float. Maybe it's a penny stock. Maybe it's a 20-cent stock. It's the one everyone's trading today, but I'm not going to trade it. It doesn't fit within my strategy. Maybe it's a $200 stock. And if that's the case, you have to recognize that that's what traders are focusing on. And it's unfortunate that it's not a stock that fits within your strategy, but if that's what's obvious today, you trading something else is probably not going to give very predictable price action. You've got to focus on the one that's obvious. So it's important to have that wide lens at the market. So when there's many stocks moving at the same time, attention can be dispersed across the market, and follow through on each one of those stocks can sometimes be less than if all attention is focused and consolidated on one or two stocks. So I always have to trade the market I'm in. I want to look for the highest quality setups. I want to be aggressive, but sometimes it's really important to be patient. And I do better on stocks with higher relative volume and also when the total volume is higher, and that's because I can trade with larger shares. So a stock that's got 5 million shares of volume, I'm not going to be able to trade as aggressively as a stock that has 100 million shares of volume.